Hey everyone, welcome. So today, we're going to talk about a pretty huge idea. I'm talking about a Nobel Prize-winning concept that literally changed the entire game of investing. It's a way of thinking that takes us from just guessing at stocks to actually, strategically building a really smart portfolio. All right, let's dive in.
It doesn't matter if you're just starting out or if you've been investing for decades. Every single one of us has to deal with this question. It's the big one, right? We all want to make as much money as possible, but how much risk are we actually okay with to make that happen? Nailing that balance, well, that's everything.
And this just lays it all out perfectly. It's that classic internal battle every investor has. On one shoulder, you've got this voice saying, go for it, maximize those returns, let's build that wealth. But then on the other shoulder, there's that nagging fear, right? The voice that says, whoa, be careful, let's minimize the risk, let's protect our capital. It really does feel like a constant tug of war.
Okay, but what if there was a real answer to this dilemma? And not just a gut feeling, but a mathematical, Nobel Prize-winning one. A way to actually structure your investments that's based on a powerful, proven theory. Not just, throwing darts at a board.
For that, we got to go back in time, all the way back to 1952. An economist named Harry Markowitz comes along and publishes this totally groundbreaking idea. It's what we now call modern portfolio theory, or MPT for short. And let me tell you, this one idea completely laid the foundation for how we think about risk and reward today. So what exactly is modern portfolio theory? Well, at its core, it's a framework for putting together a portfolio. But here's the key, and this is super important. It's not about trying to find that one magic stock that's going to go to the moon. Nope. It's about building the best team of investments that, when they work together, give you the absolute best return for whatever level of risk you're willing to accept.
Now here's where it gets really cool. This isn't just some abstract idea. We can actually see it. We can literally map out every possible portfolio you could ever create and see, visually, which ones do the best job of balancing risk and reward.
So picture this. Imagine a graph. On the bottom axis, you've got risk. Think of it as how bumpy the ride is going to be. And on the vertical axis, you've got your potential return. Now, just imagine that every single portfolio you could possibly build is one tiny little dot on that graph.
Okay, so when you plot all of those millions of dots, something really interesting happens. A clear shape starts to form. And the top edge of that shape, well, that's what Markowitz called the efficient frontier. You can think of this curve as the absolute gold standard. It's the collection of all the portfolios that are, mathematically speaking, the best you can possibly do. And this is why that frontier is so important. Any portfolio, any one of those dots that falls below that line is what we call suboptimal. And what does that mean? It means you're not being efficient. You could either be getting a better return for the exact same amount of risk or getting the same return for less risk. Either way, you're leaving money on the table. This chart just makes it so obvious. I mean, look at this. You've got two portfolios here with the exact same level of risk. But the one that's on the efficient frontier, it's giving you a way, way higher return. You're getting way more bang for your buck without adding a single ounce of extra risk. So the question is, why on earth would you ever pick the other one?
Okay, great. So we know where we want to be, right? We want to be on that efficient frontier. The big question is, how do we actually get there? Well, the secret ingredient is a word you've definitely heard before, but maybe not quite like this. It's all about diversification.
And look, this isn't just some nice-to-have suggestion. It's literally the mathematical engine that makes this whole thing work. I mean, the source material says it right here. Diversification is at the absolute core of building an efficient portfolio. Why? Because it's the #1 way you lower your overall risk.
Let's make this super simple. Take a look at Portfolio A. It's 100% tech stocks. Now, if tech has an amazing year, hey, you're flying high. But what happens if the tech sector tanks? Your entire portfolio goes down with it. You've got all your eggs in one pretty volatile basket. Okay, now check out Portfolio B. This one is spread out across a bunch of different things. You've got stocks, bonds, commodities, real estate. The difference is just boom, right there. You can see it immediately. Your money isn't all piled into one corner. It's spread out.
So why does this actually work? Well, it's pretty simple, really. Different types of investments just don't all move up and down at the same time. They're not perfectly correlated. So when stocks are having a bad day, maybe your bonds or commodities are having a good one. When you mix them all together, those individual ups and downs kind of cancel each other out, which makes for a much smoother ride and lowers the overall volatility of your whole portfolio.
All right, let's start to pull all this together. Once you really get modern portfolio theory, you can start investing smarter, not just harder.
It's all about making deliberate, strategic choices, instead of just guessing.
So here's the bottom line, the main goal here. It's to make absolutely sure your portfolio is working efficiently for you. You want to know for a fact that you're not taking on any unnecessary risk, and that you're not leaving any potential return just sitting there on the table.
You can really boil this whole thing down to a simple 3-step mindset. Step 1, know yourself. You got to define what your actual risk tolerance is. Step 2, don't put all your eggs in one basket. I mean, come on, diversify across different types of assets. And step 3, put it all together. Use these ideas to build a portfolio that's aiming right for that optimal sweet spot, the efficient frontier.
Okay, so right about now, you're probably thinking, this all sounds great, but I'm not a math whiz with a supercomputer in my basement. How in the world am I supposed to calculate all this complicated stuff for my portfolio? And you know what? That is exactly the right question to be asking.
And here's the fantastic news. You don't have to be. Technology has totally caught up to the theory. These days, there are modern tools that can do all the heavy lifting for you. They can run all those complex calculations and take the guesswork right out of it. They can help you actually apply the Markowitz model to your own investments and aim for that super important efficient frontier. So this amazing Nobel-winning idea, it's not just for academics in ivory towers anymore. It's a really powerful tool that any investor, including you, can use. Thanks so much for joining this explainer.